Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right, Tommy, happy Monday to you.
Yes, sir. Yes, sir.
All right.
It is a happy, that's for sure.
Yes, it is. Yes, it is. Here we are. We're living in Florida. Things are moving along here. Real estate's picking back up. All we got to do is get those gas prices down, mortgage rates down a little bit better. But I got a lot of things that I want to really cover today. And one of them, the main thing I want to talk about, and we've done this once before, but I want to cover reversed mortgages or HECMs specifically. So
HECM, yeah. The HECM, right?
Heck the HECM. That's exactly right. And let's cover this. And I got a few questions that I'd like you to run by me, and let's answer them together and help people understand, because I have to be honest, Tom, there's been a time where I've been quite the skeptic on reverse mortgages. Okay.
I still am.
Well, the more I learn about them, the more comfortable I am. Now, are they for everybody? Of course they're not for everybody. But I think that there's a greater need for them than what I really thought they were. So
sure,
let's just knock it out. We'll pick it apart and we'll figure out what's going to work for folks. I was a part of a training group earlier last week, or late last week, I should say. And I think that it's opened the doors for a lot of things for not only me, but some of my clients. But let's kind of knock them out. So you ask me some questions and I'm going to try to answer them for you. How about that?
Yeah. So let's go through the really quick general, what is a reverse mortgage? Because obviously a mortgage, you borrow the money to purchase the house and then you make payments, right? So what's a reverse mortgage?
Reverse mortgage it's also a mortgage. You have to be 62 years or older in most cases for your standard HECM, which is a government insured loan. So it's insured by the Federal Housing Administration, which is FH. This is literally a loan that is endorsed and passed by Congress, which should make you feel a little bit more comfortable. It allows banks to go a little bit further for the customer because they know that it's government insured. So it's a great mortgage for people that are 62 years or older and may have maybe a situation where they don't feel like they're going to have a whole lot of money to live off of in retirement. But that's not always the case. I've always thought that was the case. So there's tools that this reverse mortgage can be used for. But let's go into the next question and see where we are there.
So if we do a reverse mortgage, do I actually still own the home?
100%, same as you would on any other type of mortgage. The banks don't own your home. They just have a lien on it that would have to be paid if you were to sell it or refinance it. You own your home. You're responsible for your own taxes. You're responsible for homeowners insurance. You're responsible to maintain the property. You're responsible for your HOA fees if you have them, but you still own the home.
Okay, fair enough. Fair enough. I think that the last thing there is probably the most important thing, that you still are responsible for property owners insurance and maintaining the home, because a lot of people get in trouble when they take out a reverse mortgage, not realizing those things. So what about monthly payments? Do I have to make a monthly payment? Can I make a monthly payment? What's the deal?
The answer is yes to both of those questions. You can make payment if you want. You don't ever have to make a payment on the mortgage, ever. You don't have to. You can keep your home and never make a payment. Again, you still have to maintain the house. You still have to pay your taxes, insurance. Now, would you want to make a payment? Some people may want to make a payment, particularly if you extend a line of credit out on it, or if you just thought you wanted to keep the balance down so your heirs could have more equity when they inherit the home. You could make a partial payment. You could make interest only. You could make a 20-year, a 50-year payment. You could do whatever you want. It's totally flexible. The thing I like about it is you don't have to make a payment.
Got you. Okay. So now I know that it's mostly a line of credit, right? It's like I don't want to call it a second mortgage because it's not, but it's a line of credit versus a traditional mortgage that gets paid down, right? But
that's right.
and most people do it on like a refinance, right? But can you
No,
purchase?
it can be done on a purchase as well. So we've
Right.
got clients right now that'll buy a home. They'll put maybe 50, 60% down. The more equity you have, the more your line of credit can be. And the older you are, the more of a line of credit you can get as well. Because remember,
So
these are all done by actuarial numbers based on how long you're expected to live,
how
right?
long you're going to
So
live? They know more about how long you're going to live than you do.
probably.
So I was thinking about people that maybe move from a high cost area, New York, Connecticut, California, whatever. They sell their $1.2, $1.5 million house down there or up there, and they come down here and they buy a $600,000 house, and they can literally just pay cash essentially for that house and put a line of credit on it and never have to make a payment. And they bought the house for half price.
Or if they pay cash for the house, they don't do a reverse mortgage. They're not going to
half the cash. They can pay for half the cash. Put the line of credit on.
They put 50% down, 60% down, whatever they want. It's that the difference is you're going to be able to get that line of credit. Those line of credit, the total amount that's owed on the house generally is not going to exceed about 55% unless the equity in the property goes down. If your house went down in value, they can still not cut off that equity line. It cannot be cut off. Even if you were upside down on the house, they cannot do anything about it. You have to still extend the equity line, which is a really important thing. So you could literally you could have a reverse mortgage. And if you had a big enough equity line on it, you could use that to do whatever you want. Go on a trip, pay your bills. You could use it to buy another piece of property. Now, are they designed really to take that money and reinvest it somewhere else? Well, that's a sticky place to be, but because you're not supposed to borrow from one to invest in another, but you can. Nobody can stop you from doing it. And if you had $600,000 from the sale of a house, instead of paying $600,000 for the house that you buy here and paying cash for it, why wouldn't you want to keep that money working in the market? Cash is king. So put 50% down, keep the other 300 in the bank making money. You don't ever have to use your line of credit if you don't want to, but if you need to pull money out of the property, you can do it. You can't pull money out of a regular mortgage on a property without making a payment. With a reverse mortgage, you absolutely can.
Awesome. So what's the danger? Can somebody lose their home with a reverse mortgage?
Absolutely, they cannot. Not as long as they make their payments on their insurance and their taxes and their HOA. You have to remember, you don't have to make a payment on a reverse mortgage. However, if you didn't pay the taxes, the county could come and take your property. If you don't pay your homeowner's insurance, sooner or later, the mortgage company is going to have to pay the homeowner's insurance, and you could run into trouble like that. But you should always be able to cover your taxes and insurance and HOA fees. That's all you have. There is no mortgage payment. But they cannot take your house as long as you're maintaining the property, and they're not coming out to inspect it to make sure the house has got a fresh coat of paint on it. They don't care about that. They just don't want you to let the house go to shambles, because then their equity position is going to, believe it or not, Tom, you can't do that on a regular mortgage either. If you look at the note and mortgage on a regular conventional FHA or VA loan, you can't store explosives. You can't keep volatile stuff in the house. It's all in the note mortgage on a regular mortgage too.
All right. Fair enough. So what about taxes? If I take a bunch of money out of my house through a reverse mortgage, do I get taxed on that?
No.
Okay. That's
You're borrowing your own money. You're borrowing your own money.
Right. Okay. All right. Fair enough. And we talked about what we can use it for, so won't go through that one. What happens if the home's value drops? I think we talked about that a little bit. What happens?
That's a really cool feature for this too. So let's just say you bought a home for 600 and you got a reverse mortgage for 300,000. Okay. And you owe 300. Maybe you got an equity line and you used it and now you owe 400, but they put a sewer plant in behind your home. and your home value went down to 300,000 and you owe 400, there isn't a doggone thing they can do, and they can't cut off your equity line. It's got to continue to grow. So even if the house went down in value, that does not affect the customer whatsoever. It would affect the bank's position when you went to sell it, but you cannot, it's not going to affect you. There's nothing they can do or cut off that line of credit as long as you're paying your taxes and insurance on the property.
Got it. Got it. So I've always viewed them as something that for people that are in a little bit of financial trouble, right? Maybe they're not distressed, but they're stretched really hard. What do you think about that?
I think that it probably is the very best use. Matter of fact, it's a necessary tool for people that are in that situation. But I am not financially stressed, and I'm considering a reverse mortgage in the next few years. I'll probably wait a couple years because the older I am, the more I can get. And I'm still working, so I still have income coming in. But I could leverage that home where I would like to think that, hey, I'm going to sell my home. It'll be free and clear. I could walk away with a couple $1 million in equity in the house, or I could keep the home and live in it and enjoy my remaining years of life in that property, and use the equity line whenever I needed to. If I wanted to do something, I could take my family on a cruise. I could buy other properties with it. I could do whatever I want with it. It doesn't make any difference. So I don't think that it's only a tool for people that are in distress. As a matter of fact, a lot more financial advisors are starting to get a grasp on how powerful this tool can be to leverage money.
I'm gonna throw something out that I learned about reverse mortgages just a few weeks ago, because I did a video on my channel specifically about them and learned something that I didn't know. And then tying it in with something that you just taught me, this could be an interesting concept to explore. So you could open the line at 62, let it grow until some future date,
Not
so that
use
you
it.
have more available, not use it. Then pull all the equity out, invest that equity in the market, whatever you want to do, right? So that it's creating more income. But now you've leveraged your asset to probably the max, let's say.
Yep.
And over the next couple of years, the balance keeps growing as the interest just keeps accruing, right?
Yep.
And then one day you pass away. And rather than selling the property and having paid capital gains taxes on it, you pass away and your heirs inherit it. Now, I at one time thought that if you have $1 million asset and you owe 1.5 million, you're out of luck. And one thing I found out is that your heirs can actually buy the property at 95% of the appraised value.
At the appraised value at that time.
At that time. So you inherit it with the stepped up basis, no capital gains, and basically take a short sale on whatever equity you're not going to pay back. And it's too bad, so sad on them. So, but meanwhile, that money you took, you stuck in an account that's growing, right? And so you just helped your heirs out a pretty big amount.
Listen, there is all kind of creative tools that somebody can use to do that with. Yeah, and you could supplement your retirement. You could pay off another mortgage. You could buy another house. You could cover medical expenses if you need it. You could make home improvements. You can travel. You can help family members. You can create a financial safety net for you or your family if you wanted to. It's your equity. It's simple. And the great thing is, if you pulled equity out of a regular mortgage, you're going to make payments on it. You don't have to make any payments on this.
Right. Right. Yeah. Yeah. It's interesting. Like I said, I'm still skeptical of them, but I'm open to the idea of exploring them just because I see it as a tool. It might be a dangerous tool if used in the wrong hands, but it's definitely a tool, and people need to be educated on how to use it so that they don't hurt themselves, but they might be able to help themselves quite a bit.
I think the best thing for anyone to do is to seek professional advice. So you can call me. We will make sure we do a full consultation. There will be no sales pitch. You will get all the facts. Let's look at your situation, understand what it is, why you would want one, and then we can determine whether it's right for you or not. And again, I'm like Tom, I've been a skeptic, but the more I'm seeing this, the more I'm liking it. Is it for everybody? No, because if you're sitting on $5 million in the bank and your house is free and clear, do I really need to do it? Do you need the money? Do you really care if you have more money to invest in the market? Everyone's different. So you have to look at everyone on their own merit as well. But I will tell you this much. We used to think that, that your heirs aren't going to like it because you're chewing up the equity in their property. Let me ask you this much. Would your heirs want you not to live a comfortable life while you're alive just so they could inherit more equity? That would be extremely selfish. And if somebody wants that, then you know what? You got more of a problem with the family than you do with the reverse mortgage.
Sure.
You know what I mean?
Absolutely.
So I always thought that reverse
great.
mortgages tended to be a little bit expensive too. So that was one of the negatives that I always thought. They're a little bit expensive, but you have to remember, this is a type of mortgage that will grow and grow and grow. It's not a 30-year mortgage. It could be, if you lived for 100 years, it could be a 100-year mortgage that you never made a payment on. And believe me, the longer you live, the more you benefit from it.
All right. So
stay
healthy.
Safe. Get to the gym, Tommy. Get to the gym. Eat more vegetables, okay?
All right. Fair enough. You got it.
All right. We're going to do a lot more of these. We're going to talk a little bit more about DSCRs and bank statement programs on some of these. Tom and I are going to be here to answer all your questions. And as you can see, we're not doing a sales pitch on anything. We are going to poke holes in everything we do. We're going to look at the good, the bad, the ugly, how to use it as a tool, what dangers there may be if you got into any type of loan, whether it's a bank statement, an FHA, a VA loan. Are there advantages and disadvantages to each one of them? Of course there are. There's an advantage and disadvantage to everything. So you need the facts, and that's what Tommy and I are here to do. Tom, have a great Monday. Enjoy your week.
You as well, Bruce.